All right, call the meeting to order.
All right, and I'm going to go ahead and do a roll call. Landon Moore,
Present.
Mark Gardner,
Here.
Stephanie Elliott Williams, David Holly, Karen Savage, Mimi Terry, Derek Challenger,
Here.
Gloria Taylor,
Here.
Laura Barisha,
Here.
Gregory Coleman,
Here.
Tom Shanley,
Here.
John Morrison, Brian Birnbaum,
Here.
Jim Whitney.
Present.
Okay. Right, we don't have a quorum yet.
Is this a good time to bring that up? That are we actively trying to pursue some fire and police retirees to join the board? Because I think we've got 5, so we're down from 7 now.
Sure.
And it gets, consistently difficult to get a quorum.
Sure. I haven't gotten a chance to speak to Ms. Terry. We have been so busy, but I think we do need to focus on that. So thank you so much, Mark. I will have to speak with her.
Thank you.
Yeah, we're,
And just one other little update. I know the last time we were talking about some changes to the code to change the requirements as to what the board is, the makeup of it. And that's something that our office is looking into now. It wasn't as simple as we thought it may be. There may be some other implications that's associated with that, but hopefully that's something that can get resolved between now and the next meeting.
regarding being required for active police and fire,
Yes.
given that there aren't very many active participants left.
Yeah, in my understanding, there is either none or one.
In one of the plans.
One.
Well, then that's the one.
You too.
That solves one of the plans. Let's go. Who is it?
Go get him.
All right. Well, is it? Yeah. I guess. How do you? I mean, eventually there won't be any. So I guess at a certain point you'd have to make a change in order to have the board or could you have would you think retirees would want to participate?
I think that's definitely a viable option because they have the same interests as active members, because obviously they have an interest in continuing to get their checks. So I think they're a significant interest that's comparable to active employees in that department.
Because I guess it would be unusual, and I'm not I'm just thinking out loud here, and Brian or Jim might know. It would be unusual to not have any representation from the participants, right?
Typically. Yep. No question.
So it may be as simple as making a effort to see if first if we can make the change, and after we make the change to see whether or not they're beneficiaries who have an interest in participating on the board, assuming that they did.
Well, not that we won't do the right thing without representation, but it'd be nice. It feels a little awkward, all of us sitting around here making decisions about their money with none of them here. Okay. We'll skip the meeting minutes, and I think someone from staff has a report on the OPEB trust. Is that?
Yes, that will be Flora.
So as up to today, I don't know if you present them the last month report or May, which one you presented, because we got last minute the June report. So as up to June 30th, 2023, we have 8.5 million there. So compared to previous report, it's a bit loss. I mean, I don't know which report you have because I wasn't prepared to kind of speak, so it's out of sudden. So, but as up to today, we have 8.5 million, a bit lost. The overall unrealized gain is 1.5 million. We do contribution, yearly contribution for 2023. We did 1.5 million, and we expect to do for this year 1 million, which is coming from 500 from public utility and 500 from general fund. So you have any question?
I think they have, if I remember correctly, they have their annual meeting sometime in the fall. I don't know if anybody went to it last year. I went to it a couple years ago. I wonder if they do some sort of they probably don't record that.
It was Zoom last year, I think.
Oh, was it?
Yeah, because I think I was the one that participated in it.
Could someone check on when the meeting is for the OPEB trust?
I'll do it, and I'll report back to everybody.
Okay. Next is Greystone. If you guys are ready.
We are ready.
We are ready to hear.
Ready we are.
Did you
Welcome
all
back.
want to have me put
In
this
person.
up on the screen, or did you want to?
Everybody has a hard copy,
Copies,
so
we can
Okay.
just sort of dispense with the screen share here. Well, it's good to see everybody again, 2 quarters in a row. But want to talk about results, talk about some of the changes we've made to the portfolio relatively recently and some we expect to make between now and the end of the year, in light of some evolving thinking on markets. I'm first going to talk about capital market returns in the second quarter, and then for the first half of 2023, I'm going to turn it over to Jim. He's going to talk about what our outlook is, and then I'm going to come back and talk about the portfolio. But on slide 4 in this deck, we show the returns of the major capital markets ending June 30th. Markets continue to be strong this year. We're up, almost 9% on the S&P 500 for the quarter, almost 17% for the first 6 months of the year. That on the tail of one of the worst years we had in the history of the market, going back to 2022. As we talked about the return we experienced then, which was down about 19% for the full year, was the 7th worst calendar year return in history, well, going back to 1926. So it's always good to see as strong of returns as we've had this year on the tail end of how bad last year was. Now, if you looked under the hood, you'd see a very different story. The index, the headline index, is up 17%. Top 7 stocks, Apple, Microsoft, Tesla, NVIDIA, Alphabet, Amazon, and there's one other. Anyways.
Got to come up with another acronym.
I think somebody came up with the term Magnificent Seven. The average return for the first 6 months of those 7 stocks was 70%. The index was up 17%. They account for about 30% of the index, roughly, in round numbers. So, you got 30% of the index up 70. You've got 493 other stocks that were pretty flat, and in some cases down, many cases down. So what's driving the return is these big mega cap, largely technology stocks. And what's been driving the market recently is the hope of artificial intelligence. Microsoft was the first to come out with an announcement that it's integrating AI into its search function, and that opened the floodgates. Everybody started talking about this. NVIDIA stock doubled. It's really been driving the market. What we've seen recently, since, well, it started in June and certainly into July, is now a broadening of the market. So where the first 6 months return was driven to a large extent by those big 7 stocks, now we're starting to see that broaden. So the other companies in the index that haven't done as well as those other ones we talked about are starting to do better, are starting to outperform. And small cap stocks are starting to outperform. And non-US markets are starting to outperform. So what was a big company driven rally in the first 6 months is now broadening. And that's very healthy, we think, for markets. It's very good for potential continued strength of equities going forward. Just a couple of notes on
Brian, do
Yeah.
you believe that the Big Seven, or Magnificent Seven, whatever they're called, that they will continue doing what they're doing based on the cash they have inside, plus what AI is doing? Because AI is not going away.
I think, and this is me
Yeah,
talking,
right.
I think AI is a game changer.
I think it is too.
And I think AI is a game changer for lots of different things. It will be a catalyst for individual companies, but more broadly speaking, I think it'll be a catalyst to continue to bring inflation down. Because we've talked about in the past, when you look at prior to the pandemic, which caused inflation to go to 9%, by the way, it's back down to 3% of the latest readings. What was going on in the underlying economy was highly disinflationary. And what do I mean by that is there are factors at play in society and in the economy that is putting downward pressure on inflation. What are those things? Well, we have an aging demographic in this country. It's disinflationary. And we've, for years, had significant technological innovation that has increased productivity of the American workforce, and that put downward pressure on wages. All of that was true prior to the pandemic. The pandemic messed everything up, and things got out of whack. Supply chains got goofy. People were sitting home, they didn't work, and those that did, it was putting upward pressure on wages. We think that's a temporary thing. The technological innovation in this country will continue to persist. AI is just the most recent one. So you're already starting to see AI incorporated into various industries where we used to have bodies and seats to do the work. Now we're starting to see AI take over, and that will put downward pressure on wages because you don't need to pay a computer as much as you do people. It's bad for society, don't get me wrong, but from an economic perspective, I think it puts downward pressure on inflation, and that's a good thing because inflation has been driving markets for the last 2 years. Fed's done a great job of hiking rates to bring inflation down. We peaked at 9, we're down to 3. And by all estimates, we're going to quickly approach the Fed's 2% target here soon. So yes, AI is a game changer. Will those companies still benefit? Yeah, I think so. But in all likelihood, I think the rally that some of these companies have seen over the last few months probably got way ahead of itself. So there's still good companies for the long term. I think from a valuation perspective, some of these companies and the hope and the hype that AI has caused in driving their stock prices higher probably got a bit ahead.
Overvalued. Yeah.
And by the way, so AI is just the latest technological innovation. There will be something down the road that's nobody's thinking about right now, or somebody smarter than me is thinking about. And
AI will come up with it.
Is that?
AI will come up with it.
there you go. There you go. So this notion, though, of disinflation from technological innovation is not going away. And the speed with which it comes out probably is going to increase relative to the technological innovation in the past. Just a quick comment on the bond market. If you go down, I don't know, a few rows, you'll come to investment grade, fixed income, the Bloomberg US aggregate. This is a representation of the broad investment grade fixed income market in this country. Down about 1% in the quarter. Interest rates ticked up slightly, particularly in June. But for the first 6 months of the year, we're up about 2% on bonds. So, I talked about how 2022 was an historically bad year for the S&P, the seventh worst calendar year since 1926. 2022 was the worst bond market in the history of this country. We were down about 13%. In fact, the previous worst year prior to last year was 1994, and the bond market was down about 3%. So the good news is that things are normalizing. We're seeing strong equity prices, bond markets rallying for the first 6 months of the year. Now, interest rates since June have started to tick up again, especially because of yesterday. We had a private payrolls report come out. We have a jobs number, non-farm payrolls come out tomorrow. We'll see what that says. But what is clear to us is inflation is coming down. For all we sort of railed against them being too slow to start hiking interest rates, keeping zero interest rates for an extended period of time and contributing to inflation, they appear to have done a masterful job of bringing inflation down and, as of yet, not causing a recession. So that's sort of the backdrop. I'm going to turn it over to Jim unless there's any other questions about that, and then we'll come back to the portfolio.
I have a question.
Yes.
So when they measure the inflation rate, did they change the indicators, or they're the same how they used to be?
It's roughly the same basket. Now, if you look back from 1980, it's a different basket. In fact, we had one board meeting, it was probably at some point last year, where I forget exactly what inflation was running, but let's just say it was up at 9%, the basket that it's the way it's currently constructed today. If that basket was constructed like it was in 1980, inflation last year wasn't 9%, it was more like 15 or 16%. So yes, they make changes based on the consumption patterns of individuals in the country. But if you sort of make it an apples to apples comparison to the way it was constructed back then, the headline number understates what the inflation we
Is real,
all
yeah.
felt. Yeah.
Great to be with you in person. You look so much better than a Zoom lens. You're right, we have more slides than usual. And the reason is the market's done very well, as Brian just mentioned, both stocks and bonds in general. But what's happening underneath the current is maybe not as straightforward as it appears. And that's the reason we have more slides than normal today. So we want to look under the hood a little bit and look at it from different lenses. So if you can turn to your book to slide 6 for a moment. I'm just going to point out some differences between where we were in 2022 and where we are today. So what we're looking at on slide 6 is that dark blue line is the associated with the left axis. That's the S&P 500. The light blue line is just a 10-year treasury, and that's associated with the right axis. So what you can see is that in that September-June period, we saw just a classic bear market, just focus on the 10-year treasury. So the Fed started its tightening campaign, rates were sub 1%, moved to 5%, so interest rates were going up very aggressively. Stock prices, S&P corrected. So inversely correlated. So stocks and bonds did very poorly during that time period. And then from October in 22 through March of 2023, rates came down a little bit, and that supported an equity rally. Nothing unusual about that. And I think what we're looking at right now is, if slide to the right, is that it's very correlated. So interest rates are moving up and stock prices are moving up. That's very different than what we experienced before. That's what I was suggesting. We need to look underneath the hood here a little bit. And so what the market is forecasting is a material reacceleration in growth. And that will result in higher economic profits. That's what the market is forecasting at the moment when you see this tight correlation. So if we move to the next page, our objective now is to say, well, is that warranted? So on slide 7, we're looking at historic forecasting tools, a framework for understanding where the economy is, and we're looking at the left. We're looking at the manufacturing index, so this prevailing direction of manufacturing in our country for manufacturing, and on the right we're looking at M2 money supply, and both have had very, very strong correlations historically to the equity market. And what we're looking at for both is this decoupling. So on the left, if you look at the dark blue line, that's the S&P, and you can see that it's completely decoupled from manufacturing. If we look at the right, same thing. We're looking at dark blue lines, the S&P, and we're looking at M2 money supply, which is currency, savings, and deposits. Again, this is decoupled. So either the market is going to change or it's going to recouple because the market will correct or the data series will adjust, one or the other. And it's just quite extreme in our view, this decoupling effect, because you can look back over time and see how tight these correlations are. Next slide, slide 8. We get some questions about supply chain. This was an enormous problem during COVID, and the good news here is that supply chains have been completely cleared in our view. So it's really no longer a source of pressure around inflation. And this slide helps us get comfortable with the fact that we think core inflation by the end of 2024 will be around 2.7%. Headline inflation will be closer, as Brian mentioned, to the Fed's target of 2 to 2.5%. And this is a global index representing 7 different countries, so it's very, very broad based. This next slide also supports our view for lower inflation, and what we're looking at here is inventories are very elevated, and this is a broad-based problem. It's also at the retail and wholesale level, and you can see these are very, very high, and as a result we expect to see discounting take place here before the end of the year to help clear out the inventory, which is good for the consumer and should keep inflation in check. So let's look at on slide 10 some additional recent economic data and see if it supports this decoupling that I talked about at the start of my comments today. So if we're looking at the manufacturing, again, on the upper left, including the services component of the economy, you can see it's downward sloping. If we move to the upper right, this is leading indicators. Those gray bars indicate actual recessionary periods for the economy, and leading indicators fell again in June, and that was the 15th straight month that the leading indicators were down, and we haven't seen that since the great financial crisis of 2007, 2008. Bottom left, we're looking at small business capital expenditures, investments that small businesses want to make. And yes, it's ticked up recently, but that trend has been down for some time. And then, of course, consumer confidence in the bottom right, overlaid with the difference between the 2 and the 10-year Treasury, also rolling over, downward sloping. So still continuing to flash some concerns, which doesn't really support this disconnect that I talked about at the start of my comments. Probability of recession is another question. We tend to see a lot in meetings like this. So what this slide is addressing is the New York Fed's probability of recession. This is an index that the Fed looks at. It actually goes back to the 1960s, and it hasn't been wrong in 57 years. Doesn't mean it can't be wrong at this point, but it's been a pretty reliable indicator. And now you can see, given where this index is, it's greater than it was in 2007, just before the, if you recall, the subprime Lehman Brothers crisis. And of course,
Is this 67%? Is that 2023?
yes, that's it. That's as of June 30th.
June 30?
Okay.
But it's a 12-month recession at some point in the next 12 months.
Yep, 12 months ahead. Yep.
It's
And-
way higher than others are forecasting it.
It is, but I must admit, it's not a terribly complex way of forecasting for the Fed.
Is this an indicator of a severe recession or a soft recession, or just a recession?
Recession.
Okay.
Yeah.
It's like, is actual negative GDP 2 quarters, or when they call a recession?
No, it's, like I said, it's a very straightforward indicator. It's nothing complicated about it. It's just simply the 3-month Treasury minus the 10-year Treasury.
Okay.
So that's, call it 5.5%, 5.4% minus 4%, and then they weight that, and this is a result. Which is why it's on the same slide as the two-year, 10-year Treasury curve to the right, and that's inverted as well. And now you can see it overlaid with the gray bars, which of course are recessionary periods that we've actually experienced. So it's also, flashing recession for us. And the 2 years, maybe now it's just under 5%, 4.9%, versus the 10-year, which is about 4%. So nearly a percent of inverted. Okay, slide 12. There was a question about inflation. So here's all the inflation data you could possibly want on one slide. And what we're looking at is different measures of inflation. What this slide is meant to indicate is that if it's red, it's weaker than the prior month. If it's green, it's stronger. So overall consumer price index rose 3% in June, and that's down from 9% a year ago, which is terrific news. So the really good news is the fever of inflation is breaking, and it's slowly working its way back. And Chairman Powell has reiterated after every meeting that he and the committee are committed to getting this inflation back to that 2 to 2.5% target. And they will continue to raise rates until they get there. And yes, there may be some damage along the way. Things might break. The regional banking crisis, we lost this. We have a bankruptcy of the second largest bank in the country, Silicon Valley Bank. That's a casualty of getting interest rates where it needs to be to bring inflation back down to 2%, 2.5%. So what we're looking at here is a variety of different inflation measures. The Fed, as we all know, focuses on the core PCE, which is the third one from the bottom. And it hasn't moved all that much, maybe 40 or 50 basis points. And this is the one the Fed really cares about. So the Fed is likely just to keep rates elevated until this number does start to indeed roll over. But we're getting there. The June number was a pleasant surprise at 4.1%. So this it's not fully updated.
What's PCE?
Personal consumption expenditure.
So that's more of a consumer.
No, it's the big difference, the delta is that it allows for substitution.
Okay.
So whereas the other, like the core CPI, and the CPI is a fixed basket, the PCE allows for substitution. So car prices have gone up substantially. So if consumers buy more bikes, then that's picked up in the index because they're substituting their transportation from bikes to motorcycles to scooters to whatever. So there's a lot of substitution, and that's why it's a broader basket, and that's why they like it. More comprehensive than CPI. So other inflation measures are falling faster. We call those the sort of the larger headline numbers, but we know that the Fed, because they articulated this, they're focused on this core PCE number.
A quick question in reference to inflation. Would you agree that it'd be very difficult to get below this level as long as employment stays high, the real estate market still stays high, that it's almost impossible to get to the Fed's rate as long as those two things remain high?
Excellent question, and maybe we'll hold the response till we get to a slide that addresses your question. Which would be the next slide. So this really is the challenge. This is the quagmire. So if we're looking at inflation, which is the bottom left, it's about a 50-year low. And it's really hard to engineer a slowdown when we have 3.6% unemployment. And the Fed understands that the employment rate might pick up as a part of this tightening process, but it's hard. We don't have recessions when we have 50-year lows in unemployment. So if history is a guide, this number will start to tick up as the Fed continues to tighten. And to your point about real estate, particularly residential real estate, I think about 60% of the of mortgages are about 3.5% or under. So those 30-year mortgage rates are now closer to 7. So people aren't moving. The inventory is very low, and we're not getting a traditional recession in housing because the consumer has a great mortgage rate and is not as affected by a 7% mortgage because they've locked in 3.5%. Unlike Europe and the UK, where the majority of the mortgages are floating rate and not fixed, it's flipped in the United States. So the housing market in the UK is, as an example, is very different, and they're under tremendous pressure because they're also behind the inflation curve. So yes, this is the linchpin. So this number should start to edge up. But as Brian mentioned, so far the Fed has raised interest rates 525 basis points, one of the most aggressive campaigns in 40 years, and seems to be engineering a soft landing. Economy is doing reasonably well. Second quarter GDP was 2-ish%. Far away from a recession. There was some data behind that we think will soften, but all in all, pretty good. So this next slide is sort of where we are at a disconnect with the equity markets. This is slide 14. So on the left side, we're looking at earnings. These are consensus estimates for earnings. And the top, the green line is the consensus estimate for 2024. It's $246 for the S&P 500. And then below that, 2023, the consensus is $220. And we were at see the blue line for 2022. I guess our view is that, and I'll show you a couple of slides that support this in just a minute, is that this 220 estimate for 2023 is high. And it would be our expectation that that earnings line for 2023 will ultimately pierce the 2022 number. I'll explain why in just a couple minutes, but to be clear, our estimates for 2022 are about $185, so 10 to 15% lower than where we are today. But I think it's time to have a reality check, because we're not infallible. And where are we today relative to our forecast? So we thought earnings would be down 10 to 15% this year. We still think the back half of this year will be weak. Actual reduction in earnings this year is closer to 7%, so about half of what we were forecasting at the start of the year. So earnings are down about 7. We said 10 to 15%. So we just think that's been delayed for different reasons, but we'll get there. But it probably won't be as severe as we thought, that 10 to 15%. The market just seems to be incredibly resilient, and it may be tied to 50-year lows in unemployment. Moving to the right on this slide, this gets back to the Magnificent Seven. We just looked at the data slightly differently. We pulled out the top 10 stocks and then valued those and compared that to the remaining 490 stocks in the S&P 500. And you can see the difference for the top 10. The forward multiple on those stocks is 31 times earnings versus 19. So it's pretty extreme. It's almost 1.5 times the rest of the market for those top 10 stocks. Significant value dispersion. But the good news is that those earnings estimates, earnings are still solid, and it's creating a broadening effect away from these Magnificent Seven, or in this case, the top 10. I think it's also important to put our earnings number in, contextualize it for what we're actually forecasting in terms of the price index itself. So we're at, call it 4,500 on the S&P 500 today. Our sort of base case would be 4,200. So that's an 8% difference. And I know as advisors, this gets to be a bit too nuanced for us, because, and for you all, because we're looking at things at much longer time frame than this quarter, or between now and the end of the year. But we have a responsibility to share our thoughts with you and manage the portfolio accordingly. And over time, these tactical decisions that we've made to underweight or overweight particular asset classes, they've really added value, which is why we focus and take some of your time and energy during these meetings to discuss these points. So our forecast was 17 times earnings, market's about 20. So if you look at this page and say, okay, well, where are we mid-year? Well, earnings were, as I said, at declined about 7%. We thought that would be greater. The multiple on the stock market, we thought would be a reasonable multiple would be closer to 17 to 18 times. The market's at 20. The difference between 17 and 20 is probably this enthusiasm around artificial intelligence, AI, and overall an economy that's a little bit stronger than we anticipated here at the midpoint of the year. Slide 15. Why did we think that earnings should be lower? Why do we think they will be lower going forward? So let's look at the S&P 500 earnings per share. It's a bottom-up consensus. This goes back to 1990. And our assumptions really are not heroic. They're fairly straightforward. So you can see this sharp increase in earnings per share. What caused it? There was $9 trillion of stimulus, called half from the Federal Reserve, half from the government, and that created a surge in GDP, which resulted in inflationary pressure in the system. And the question we're asking ourselves is, if we look at this sharp upward sloping line, is have average corporate profits changed structurally? Are they structurally higher because of COVID stimulus? We think not, which is why we have that light blue line dipping down. The revenue is reported in nominal terms, so inflation is rolling over, so that revenue reported in nominal terms will also start to roll over, and we think both volume and price will come in as a result. And so all we're saying is we just should get back to normal. And I think if we saw this happen, then that would get us much more optimistic about equity prices. Slide 16, on the left just shows that the 10-year Treasury yields are going up, and cyclical stocks are following it. So that's what you'd expect in a market where investors are discounting stronger economic growth. The right is important because here I'm really focused on next year. So let's look at the far right of this curve. For 2024, the estimates. And the key takeaway here is that investors have confidence in a reaccelerating economy, number one, the taming of inflation, which we will agree with, and then falling interest rates. So one area that I know Brian and I are very sensitive to is that investors may be aware that earnings will come in the second half of the year. But maybe they're already looking through that, saying, yes, we expect earnings to be down maybe 10% between for the year, from 7 to 10, call it. But as an investor, maybe what I want to do is I want to be looking into 2024. We're already more than halfway through 2023. And you can see this acceleration in expected earnings for 2024. And so maybe investors are saying, I just want to be invested going into 2024.
What do you think the impact of student loan payments being resumed will have an impact on earnings, especially as it relates to student loan payments having to start in October, going into the holiday season, which is such a large percentage of most retail revenue? And going forward, is that the catalyst that you could possibly see as the basis for a more recessionary environment?
The first couple slides that we looked at this morning related to consumer demand, and those indicators are already flashing levels of concern. So with student debt repayment pressures just adding to that, it's just going to continue to add pressure to the consumer spending line. And the consumer, broadly speaking, is about 2/3 of our economy, so it's not insignificant. The timing isn't great for what is already a softening consumer.
When do we get to the good news?
Right now. Next slide. All right, so let's look at slide 18 for a minute. And Andrew Slimman has a unique role at Morgan Stanley, which is why Brian and I and others follow his work. So he's actually managing capital. He runs multiple strategies. He runs a global strategy. He runs a U.S. equity strategy. Super smart guy, very, very thoughtful. But we also like to talk to somebody who's actually deploying capital for a living and getting his or her perspective on the markets. And so he had a call recently, and he's also on our global investment committee, so he's a member. So it's not that he's disconnected from our investment committee's thinking. But this relates to his personal views, which are separate than the investment committee. So I just want to be clear about that, so there's no confusion. But his slides, we thought were very interesting, so we wanted to share them with you, and we think that it has implications for what we want to do to the portfolio between now and the end of the year. Brian will cover that in his comments and his review. So on slide 18, what we're looking at here is, on the left, the AAII Bull Bear Indicator is the American Association of Individual Investors. It's a big group of retail investors that get independent data from this organization. I'm a member, I track it, I follow it. And they do these surveys, and the survey says, are you bullish or are you bearish? And they do them with regularity, and they tend to be provide good data points. Sometimes they're just contrarian data points. So the point here is, while investors say they're more bullish today, they really haven't acted on it. So left says the retail investor is bullish. The right side says, well, let's track money flow. And they track the money flow of the retail investor. So despite the market rally this year, flows remain negative for the year, for the most part, from the retail investor. And if we look at what happened back in 2020, we saw the retail investor was bearish, got bullish, but the money flow didn't come in, and then all of a sudden there was this catch-up trade where the retail investor said, hey, I'm missing out on this rally. I'm going to start moving off the sidelines. And why wouldn't the retail investor be moving off the sidelines? Because they're gorging on 5 to 5.5% short-term yields on money market funds and T-bills. So it's really hard for them, and those yields haven't been around for a very, very long time. So those flows haven't gone in. And his point here is that will flip at some point, especially perhaps here in the fourth quarter, if the economic data remains strong. And there's this fear of missing out on the rally, and there's too much cash on the sidelines. Typically what happens is the Fed has to start cutting rates, so those short-term rates that the retail sector is enjoying, they start to go down. And that's when the money really starts to flow. And that's, we think a lot of this money is trapped on the sidelines, or he thinks, waiting to get into the market. And this capitulation of funds flow is what happened in 2021. And the market, as you may recall, was up about just under 30% there. So we're here also.
This is contrary to what Morgan Stanley believes.
It is. It is. Yeah, I spent 10, 15 slides telling you what Morgan Stanley believes,
Yeah.
but we also want to give you a flavor of what could happen and why we might be wrong. And it's this wall of money sitting on the sidelines for the retail consumer. And the next slide, I'll close on this final slide, is if you look at Wall Street strategists, they're not optimistic about 2023. So we have lined up, Andrew has lined up 18 strategists with their year-end price targets for the S&P. So here's a potential another catalyst for better markets next year. Is that when strategists expect less than a 5% upside in the move for equity prices in the year, it's a bullish indicator. And so something is going to have to give here. So the average is about 4,000 on the S&P. As I said at the start, the market's already at 4,500. So either the market's going to correct and they're all going to be right, all 18 of them will be right, or they're going to start raising those price targets. And we just started to see some of these price targets go up. It's like Citigroup raised their price target for this year to 4,800 as an example. So these are the things that we think about. We've got a formal Global Investment Committee's perspective, which is really well-grounded in your portfolio, and you'll see that in just a few minutes. But these are some of the other things we think about. And if we think that 2024 earnings are going to be healthy, we don't think they may be up 12%, which is what the consensus is, but positive, and we get a softening between now and the end of the year, do we really want to go into 2024 underweight equities with some of this additional consumer buying power? Maybe not.
Say Citigroup went to 4,800?
Yes.
It went from 3,900 to 4,800.
But that's just an indication. You know, 1 of 18 flipped. So, right, Citigroup has a lot of clients, right? They raised their price target. And
So is this analysis all-inclusive for our portfolio? So S&P, since I see the allocation, equity is almost 70% and stuff. Is this analysis for the whole portfolio we have?
yes, so that we're going to
Okay.
segue right into that now.
Okay.
Yep.
Yeah, just real quick on that. Most of our equity exposure is going to be in that S&P 500, not all of it, for sure. We've got smaller companies, we've got non-US companies, we've got emerging market investments as well. So it's a broadly diversified equity portfolio, but the lion's share is going to be in that
Okay.
S&P index. Okay. Here we go. So let's go to page 42, and then back to the portfolio. I just want to show you where we're at. So our targets here, 70% equities, 22% bonds, about 8% alternatives. And just to remind you, on the alternative side, we've got a little bit of hedge funds, we've got a little bit of real estate. In terms of our actual allocations, if you move over to the pie chart on the left-hand side, we're roughly right on target, slightly overweight, but right on target with the alternative side. We're underweight stocks, and we've talked about this for a while. And the reason we've been underweight stocks is because of the sort of the house view on the general cautiousness we've had, particularly about corporate earnings. Again, as Jim talked about, that hasn't really materialized to the extent we thought it would. But we're underweight stocks by about, in round numbers, 3 or 4 percentage points. Not a huge bet, certainly well within the ranges allowed in the investment policy statement. But it's been a drag. It's been a drag for the last 12 months. And so, given some of the other things that Jim talked about related to what one of our colleagues talked about, Andrew Slimmons, the market looking through maybe the second half of this year and into accelerating corporate earnings growth into 2024, it is our expectation that we will get to target by the end of the year. So we're set up for being on our investment policy targets to start 2024. Now, whether we do that, we're not going to do it all at once. We're going to do it in a methodical way. We've got about 3 or 4 points to move, but we do want to get to those targets in light of some of the evolving thinking here. We hope, this sounds weird, equity markets pull back 8% or 10% or whatever the number is so that we can add into some of that weakness. So underweight, we'll talk about the impact that had, but our expectation is we're going to get to a 70% target in the next 4 or 5 months.
Quick question.
Yep.
The cash, is that cash literally or cash equivalent, meaning treasury bills?
It's the latter. Yeah.
Okay.
So it's earning, and a lot of the cash is transitory too. So as benefit payments go out, at the end of any month, we might pick up some residual cash that's waiting to go out to the beneficiaries. But it is earning a competitive interest rates as we wait to sort of issue those checks. Any questions about that, where we are, where we expect to get to? Because it's different, right? I mean, if I'm sitting in your shoes and I listen to me talking and say, well, you're throwing in the towel. And I don't think we are. I think the market's changed and it's evolved. Inflation's come down significantly. It's getting under control. The Fed is getting to the end of its rate hiking cycle. It's very different than where we were, say this time last year, where it was really unclear as to how much further the Fed's going to have to go. By all estimations, it's kind of a coin toss about whether the Fed hikes another 25 basis points at the beginning of November. And from our perspective, in some sense, it doesn't really matter whether they do 25 or whether they stay on the sidelines. Because as we look at the futures market and what the market is pricing in the Fed to be doing, the market is expecting significant rate cuts in 2024. And so
Say that again.
the market is expecting significant rate cuts in 24.
Okay.
So, and when I say significant, anywhere between 100 and 125 basis points, that's significant. And typically, that's supportive of equity prices when that happens. So things have changed, our thinking has changed, and we want to position ourselves to capitalize on sort of the changing dynamics that's going on in the market.
Brian, if we don't get the 10% correction,
Yeah.
are we still going to?
Still moving.
Okay.
Yeah, yeah. And we don't know if we will or we won't. We think it will be constructive if we do, because you look at the stock charts, I mean, it's been straight up. Again, it's important to keep in mind it's driven by largely 7 stocks. We're underweight those 7 stocks, by the way, I'll talk in a minute. That's hurt us. That explains a big chunk of the underperformance. And the reality is to be overweight those 7 stocks, you have to have almost, 40% of your portfolio to be overweight those stocks by 10 percentage points. That's a really, really concentrated bet. But the reality is those companies have done extremely well.
And maybe I'm ahead of myself, but on the page 45 attribution summary, I see the benchmark return 4.24,
Yep.
NRC ours is 3.26.
Yep.
Some of the effects is this almost 1% broad allocation effect and
Yeah.
what are these?
Yeah, let me come back to that in a second.
Okay.
Let me ask everybody to turn to page 54. I want to show you the numbers. We've been, talking about markets and stuff, and we're, an hour into our presentation. I told you what the
I
return.
always sort of ask the same question about this concentration thing, and this isn't new. It happened, I don't know when the whole FANG
Yep.
acronym came up. It
Yep.
was, I don't know if it was 19 or 18, but it seems like professional money managers don't want to have that sort of concentration. So is it literally all the retail investors that are driving that sort of concentration of returns in a small handful of stocks? And if I don't know if there's more retail money than there is institutional money, and if the retail money investors want to do that, and professional money managers can't get their head around
Yeah.
having that concentration, like what's going to give?
So there's 2 things, and actually kind of three comments I'll make. One, there's been significantly more money that's moved into passive management and indexes. And so by default, if you're a big company and more money is going into passive, that's going to increase the amount of investment that is in your individual stock. So that's the first thing. Second thing, you look at, I was going to say any institutional money manager, never talk at extremes, but most institutional money managers are underweight those stocks because they are far too big. I mean, you look at Apple, I think Apple's probably in the S&P about 6 or 7% of the S&P 500. You'd have to have, call it 10% of your portfolio in Apple to be overweight that stock. And for most risk-focused institutional money managers, it's far too much. The third thing I'll say is, yeah, I think the toggle is the retail investor, and they tend to be driven more by momentum. So as things are going up, Jim talked about this fear of missing out, FOMO. They want to buy those stocks, and they want more and more of those stocks. And so that then drives the price of those stocks higher and the weight in the index higher. So those are three things that come into play. Let me temper that by saying these are good companies. These are the companies you want to own for the long run. And over the next 10 years, I think these companies are still going to be the winners. But their stock prices get ahead of themselves a little bit. Earnings will catch up, and their valuations will come down. But in the short run, you can have a correction as things sort of reconcile. So, page 54. Talk about returns. We show a number of different time periods here. So the second column, well, actually the first column is just the month of June. Looking at the net of fee returns, the last gray row there, 3.8%. The one right below that is our benchmark, 4.1%. So a little bit below, certainly positive returns, which is great. But a little bit below benchmark. For the quarter, you can see we're significantly behind. And Flora, I'll come back to the attribution in a second. We're about 90 basis points on a net of fee basis behind the benchmark. That's dragged our year-to-date return down. All of the underperformance for the year-to-date period is coming from the second quarter, and we'll talk about that in a minute. But we're up we're up a little bit north of 9% for the year. If you go up, you'll see what that means in terms of dollars. That 9.25% return means that we have over $16.5 million more in the trust than we did at the start of the year. We show the last 12 months here. This is an important number because this coincides with the end of your plan year, which is going to roll through the actuarial valuation and required contributions when Tom and his team get to that later in the fall. We're up 10% on a net of fee basis, over almost 10.1%. And just to remind you, when we think about the liabilities and what we expect the liabilities and the assets to do, our expected return is 7.25%. So the plan year ending June 30, 12 months ending June 30, we were about 300 basis points ahead of what the actuarial return expectation was.
If you had asked me at the beginning of the year, if we'd be up 9%
I'd say no way.
right now, I'd take it in a heartbeat.
Yeah.
But still, don't love the underperformance against the benchmark.
Yeah. No, I hear you, and two things driving the underperformance, and this kind of gets to attribution. One is we've been underweight stocks. Second is we've been underweight those biggest companies in the index, and so by definition, then we are overweight smaller companies. As I talked about in July in particular, we've started to see a broadening. So it's the smaller companies that are doing better. It's the non-US markets that are doing better and away from those big mega cap names. Apple reports after the bell today. We'll see what they do. Could be the impetus for either a sharp correction or a sharp rally in the market. So we'll just kind of have to see. Last thing I want to point out on this page, since inception, since we started working together since the spring of 2016, 7.3 versus 7.6, slightly behind the benchmark, but at $192.6 million, that return exceeds the actuarial assumption, number one, and translate into about almost $86.5 million in additional trust fund assets. So those are the results. Disappointing, but we kind of know not unexpected given the positioning in the portfolio we had. I'm going to ask you then to flip back to page 45, and Flora, here's where we get the attribution. So what is this thing called? And this is just for the quarter. So we underperformed by about 90 basis points or so. Those three middle columns in that graph on the top of the page break it down what are the sources of those underperformance. So broad allocation effect, what does this mean? This means that we were underweight stocks relative to our 70% target. And as I showed you earlier, we're about 3 or 4 points underweight. If we were exactly on our, and I'm talking in round numbers, but if we were exactly on our 70-30 stock bond mix each and every day in the quarter, that broad allocation effect would be 0. We were underweight stocks did well. Our return was hurt by about 15 basis points as a result of that. The sub-allocation effect looks within equities and says, okay, what does my stock portfolio look like relative to the benchmark? And I talked about we're underweight the biggest 7 names, and so therefore we're overweight some of the smaller companies in the benchmark. That impact is what's picked up in the sub-allocation effect. That had a bigger impact than being underweight stocks, because it was those 7 stocks that drove, by all intents and purposes, all of the return, and we were underweight those stocks.
Is that both like geography and small cap, large cap? Is it also like just those two?
It's all of that. It's
Value
growth. It's regional. It's large, small.
in sectors too?
Yeah. So it's how different does our stock portfolio look relative to the benchmark? Yeah. The biggest difference, I'll tell you, is we're overweight small cap stocks, we're underweight those biggest companies.
I have to think about this too sometimes when I haven't seen it for a while. And I don't know that we need to add more pages to your slide deck, but like, maybe it would be helpful for a description of those 3 categories. That'd be.
Because these are things that we can improve and we expect to be improved in the future. You
Yeah.
know what I mean? So
Yeah.
that's why it's the step. Okay.
Yep.
Yep. What? The definitions of those attributions.
The third component is what's called selection effect. And so these are whether the managers we have in place in the portfolio were able to beat their benchmark or not.
Because we want the best managers. So this should be 0. I'm kidding.
Over the short run, and a quarter is short, it's anything can happen over the short run. Over the long run, we can show you that the managers have added significant value. But in any given quarter, any given year, quite frankly.
So if you look at this over a longer period of time, the managers,
Yeah, in fact, let's go
the broad.
page 55. So this shows individual manager returns. So the managers we have in place in the portfolio, we've got a mix of active and passive management, as you know. 5 of the active managers that we have in the portfolio actually outperformed their benchmark the second quarter. 5 of 8. So more outperformed than not. And the same is true over the year-to-date period. 5 active managers outperformed their benchmark, 3 underperformed. So more of the managers we have are doing well. There are some that are underperforming slightly, and I'll say we made some changes during the second quarter. And we talked about this at the last meeting. Some of the things that we were doing to sort of streamline the portfolio. I would say we made 3 significant changes on the manager side. One is we terminated BlackRock which is a fixed income manager. Their results were unimpressive. They didn't underperform, they didn't outperform, they were right on top of the benchmark. We thought that we could do substantially better than benchmark returns in bonds, and so we made that change. The change we made, if you go down on page 56, about halfway down the page, we added a firm called Loomis Sales, and we added them in middle of April of last year. The result is their return is negative, but they outperformed their market benchmark since inception by about 30 basis points. Loomis Sales is well-known. Landon, I'm sure you're familiar with them. Well-known fixed income manager, focuses typically on corporate bonds in this country, but they have a diversified portfolio. It's a firm that we like very much. And out of the box, they're doing well. So that was the first change we made. The second change we made was on the second and third changes we made were on the non-U.S. equity side. We had a dedicated portfolio that focused on Japan. We eliminated that and rolled that into a broadly diversified non-U.S. equity index. So we moved out of Japan and got more diversified. The third change we had.
Internationally, you got more diversified?
Yeah, good. Yeah. The other change related to emerging markets, where we terminated an active manager we had and consolidated it with an active manager we had in the program, a different active manager we had in the program. So we culled the roster down a little bit. That manager that we terminated is a firm called Artisan Developing World. They've added a massive amount of value since inception for this plan, but their portfolio looked very concentrated to us, and we wanted to put it in something more diversified, so spreading some of those active bets out a little more. Those were the three changes we made. And a lot of that underperformance from the active managers that we saw in the attribution is coming from some of those changes that we made that are no longer in the portfolio. So again, over the long run, active management has done well for us. We've, as I look at the last, call it year and a half, what's really hurt us is the underweight to stocks, and we're going to solve for that. Some of the capitalization bets we have on the portfolio, this overweight to small cap stocks, that seems to be playing out here, and there's a rotation into some of those names, so that should help us going forward. We really like the active managers we have in the portfolio. They've all done, most of them have done pretty well for us over time. So with that, I'm going to stop and see if there's any more questions, comments, or...
You expecting more rebalancing of the portfolio to different managers?
We feel good with the managers we have in place. Unless something happens that is out of the blue, I wouldn't expect material changes on the active management side. We like the managers that are in place.
Other questions, comments?
I think we hired you folks to run our portfolio. And us as a board, and this is just me talking, us as a board should not be too concerned about all the technicalities of the portfolio itself, because it's what we pay you guys for.
Yeah.
Although we are under a little bit this year, I think you're doing a pretty good job. I think the Gray State probably assumed that we would be more bond related than we than we got to. The market was not following like we thought the market was going to follow this year. And that being said, it sounds like you're readjusting toward the end of the year and getting ready for '24, more so than the end of the year. Is that a safe assumption?
It is. I think the worst thing that Jim and I can do in our role here and with our other clients is to be stubborn.
Is what?
Is to be stubborn.
Oh,
And the interesting thing about what we're talking about doing, so, we're at 66, 67% stocks. We're talking about increasing that number to 70, which is our target. And in some sense, you might say, well, you're putting risk on the portfolio, you're taking more risk. And the way we think about risk is that risk relative to the benchmark. So we're, in a perverse way, we're de-risking the portfolio. A lot of the moves that we made on the active management side were de-risking moves. Okay, we've got rid of concentrated managers. We got rid of managers that weren't performing in a way that we were hoping. So that was in some sense de-risking. And even though we expect to increase stocks between now and the end of the year, it's de-risking relative to that benchmark. So this is always a humbling business, and we could have the best rationale for thinking that the world is going to unfold in the way it does, that we expect it to. And ultimately, the market will tell us if we're right or wrong. And at this point, given sort of the changing dynamics on inflation and expectations for interest rates next year, we think it makes sense to be positioning the portfolio to capitalize on it.
I think also, thank you for your comments, but I appreciate those. And we view our job as also to be the steady hands on the wheel. And this year we generated $16.5 million of additional value, and since we've been involved, almost $86 million of enhanced value. And what we're talking about here is a couple percentage points of the portfolio. And Brian, I know Brian and I are very competitive people, and we have confidence that with 80% of the portfolio in active managers, that we'll get there from a performance standpoint. But it's really been a lot to navigate. We went from a thriving economy to one that's shut off overnight in a pandemic, and then reopened with double-digit rates of inflation. And so our primary job is to be the steady hands, keep the ship moving forward, so that we can generate
For the long term.
For the long term, to generate these returns for the plan beneficiaries. And that's our primary responsibility. But it's certainly our expectation that the absolute performance numbers will improve.
And I don't want to beat this horse to death here, but the underperformance that we've had since inception is really just the last year and a half. If we measured the results, and we can show them to you, I'm going to think from the top of my head. At the end of 2021, this portfolio's return was outperforming the benchmark by somewhere between 150 and 200 basis points. We had built up extreme amounts of excess return. Now, that's been offset from the last 15, 18 months. We don't ever expect to outperform in every single period, but over the long run, we would expect that magnitude of outperformance to come back.
can't knock a home run every time, right?
That's right. Every once in a while.
Is it, if I'm right, if I'm summarizing, it sounds like, you had a position, it hasn't played out over the last 12 months, you're getting back to the benchmark until you come back to have another conviction that you want to.
I think that's right. It's not to say, by the way, it's not to say we won't have bets in the portfolio. We will. We're still overweight small cap stocks. We're still underweight those big remains.
We're getting closer to the benchmark.
That's right.
But still, we expect better, because our funding status decreased a lot. Funding status.
Well, it wasn't
you know,
because of
for-
investment.
Even though, we had a bit increase, still we didn't cover, because back in 21, we were at 85% funding status, and now this year we're at 65, something 66, between plans, which means even though the increase, whatever, this year, it didn't recover the losses in 2021 and during 2022.
And the actuarial work that Tom's group puts together, which we'll get to
Yeah.
in the fall, shows an expectation that the funded status over the next several years is going to go down.
Okay.
And then it sort of ramps up from there, number one. Number two, the actuarial projections are projections, right? They're assumptions that get embedded into a model. The return expectation for the assets on the actuarial side is 7.25%. The returns that over the last 12 months have been more like 10. So from an actuarial perspective, the return did a lot better than we assumed.
Yeah, this year.
The reason why the funded status is going down, even though the investment returns are better than expected, is because the amount of benefits we pay out are so great every year relative to the contributions that come in. So the way to think about it was it.
Yeah, but we didn't give them a COLA this year.
Yeah, the COLA is not.
It's not like we increased the distribution.
No, but there's $30 million roughly that go out in benefit payments each year.
Yeah, which should be equal, maybe additional, whatever new employee got retired. We should be close to the same. So benefit distribution of benefits is the same practically as in 22, same
Yeah.
as in 23.
Yeah, it's not going to move that much.
It's not going to move that much. You know what I mean?
No, but
So-
you can think about, so $30 million coming out every year. What's it, about $8 million coming in?
Less than that, I think, came in for the contribution.
So net cash flow
Running.
is about, let's just call it 22 million. 22 million, and I'm going to do.
I don't want to go to technicalities.
But-
what I'm trying to say is this, that during 2022, the loss was such
Oh, yeah.
huge.
Yeah.
So we still didn't recover for it. So we're going to have to kind of work better
Yeah.
in future,
Yeah.
you know what I mean? So I don't want to go, it happened what happens. But our funding status decreased.
Yeah.
Because our purpose is this. We would like to have money till a standing employee there.
Understood.
So, and based on this, we're going to have to kind of have a plan, or because a good funding status for a company or for an entity is at least to be wealthy. It's at least 80%.
Correct.
I'm not thinking
Yep.
going to 80%, but at least close to 70. Either we're going now that means on top of that, if we don't get through returns, we're going to have to pay more contribution.
Yep.
So that means this year's contribution is going to be changed because last year we paid something we shorted. I believe Tom was 8 million, 9 million.
The contribution?
Contribution
I think it's around 7.8.
7.8, but the previous year was 10 million.
Yeah.
Now we're gonna go to 10 million again, because I'm thinking from the city's point of view, and from our retirees' point of view. I'm not seeing, your part. So that means we're gonna have to pay more money or do something, what's our plan?
Yeah. And from a cash contribution perspective, we'll see what the numbers look
Yeah,
like.
yeah, let's
They're going
hear-
to-
yeah, I'm
they're
gonna
going to
ha-
be,
yeah, yeah.
I would assume, they're going to be very similar to what they were last
Okay.
year.
So that means 8 million. Okay, I'm fine with it. As
Yeah,
long
I
as
mean,
you don't
we'll see.
increase our contribution, I'm fine.
Stacy, I don't know if you want to bring up
We'll do that.
it's titled COP Funded Status Reconciliation. But, so this is, and good morning, everybody. Thanks again for having me. I haven't been here since February, I think, and I'll be.
Good segue to Tom.
I'll be brief. I'll be brief here. I know with regards to time, but just to give an update on what we're doing from an administrative operations standpoint, and just take a quick look at some of the estimates, and then quick look at changes in the data. But this is the estimated funded status report that, and again, this is estimated. I mean, one of the things you will see that this was actually put together before the final quarter end valuation. So the good news is you're going to see market value of assets reported here around 188 million. I think we actually came in around 192. So that's going to help a little bit as well. But for the most part, what you're going to see is the estimate is really targeting for the overall funded status for the combined system to be pretty flat from where it ended last year, around 67%.
to where it probably is going to be this year. So again, I don't want to, I'm not an actuary, I don't want to get into what else may impact it, but we know, and as Brian said, we've provided out some longer term projections. We kind of have a good idea of well, how the system's going to move at this point. And almost a lot of the liability, at least from what individuals are expected to get, is locked in. It's just the other variables that are going to impact it.
The remind me or tell me if I'm remembering correctly. I think our funded status percentage has gone down, but the actual pension deficit has decreased in dollar terms.
Yeah, that was the case as of last year. Yeah, so that variance. So if we go to page 3 on this, the first 2 pages we split out the 2 systems, the supplement and the fire and police. That was the right one.
That was okay.
Yeah.
I was wondering.
Yeah, if you just want to go to page 3, which is right here. Yeah. So at the very top, this looks back. That's 21 to 22. So Flora, to your point, the funded status a couple of years back was definitely at a higher point. But if you look at June 30th, 2022, roughly that's 67, 68%. And then if we scroll all the way down, so this is just looking quarter over quarter activity, a little bit further, right, a little bit more, right there. So this is where, you know, the projection came in at the end of 2Q. Again, as I mentioned, we're kind of undervaluing the market value of assets, but
Do we have any policy or something that what's our percentage should be, or just did we ever?
What the target valuation is? So I know the board and the cities talked about that goal of 80%, and I think
yeah,
until that point, COLAs won't be added.
Okay.
So that's the goal. But again, I think based off of the longer term projection, it'll probably take a little bit of time to get there.
Okay.
But there's absolutely no concern around, you know, the amount of assets that are allocated to the program to continue covering benefit payments. And as we said, so in the next meeting, John Morrison, the actuary currently working with you all, he'll be here to.
And this is the supplemental one. It's not the other one. The other one is even lower.
That's
Yeah.
combined.
Oh, that's combined? Okay, good.
Yeah. Yeah, so
Yeah, I
the
have
first
that.
2 pages, we break it out, fire and police, and combine.
Okay. Yes, I do have it.
All right, so just if we jump over to the other document, I think it's called City of Portsmouth Retirement System Board Meeting Presentation. Again, I'll be brief. I know we're at time here. Yep, there we go. So why don't we just move ahead to slide 5. So typically, as we scroll by those screens, you know, I'm going to just provide really brief updates on a handful of different things throughout the year, just so that as the board changes and members of the city change, there's just an awareness. So, you know, again, John Hancock is providing really all of the combined, outside of the investment management, the combined services to run the program, from the custodial to payment, to participant member support ongoing, all the actuarial services, et cetera. Thank you. So one of the things we just like to report out on is data security, the importance of cyber threats. Not really as common in a pension system as we do see attempted fraudster attacks on the 401k side of business, because there's a lot more ability to access money easier, quote unquote, or without, you know, a steady stream of income. You know, in a pension plan, a fraudster's not going to attempt to get at that money knowing that they're going to get a monthly benefit check continue to be sent to them. You know, they may look for one-time hits, whereas on the 401k side, there's withdrawals, there's loans, there's a lot more opportunity of assets. The good news is, you know, we continue to be extremely secure in how we're built. from a front end standpoint, from what the individual faces to everything we do on the back end side to our ongoing data communications with the city. And that's built kind of this multi-layered from Manual Life, our parent company, down to John Hancock, then Retirement Plan Services. We have the highest certifications required, you see there. The different SOC reportings, I know we go through some of these with the annual reviews from an audit perspective, and then we do use a 100% cloud-based storage system which picks up the information from us and moves it off of our servers to this Microsoft Azure cloud.
And speaking of this, we need a bridge letter. So
Bridge letter,
Yeah.
okay, we can get that for you.
Yeah, thank you.
So again, I won't go through all this in too much detail, but 2 years ago, the Department of Labor came out with best practices. Those are both at the provider level, that's us, at what we would say the sponsor level, which would be the city and the board, and then from the participant or the member level, so the benefits for the individuals getting. We have all of those covered from our standpoint, and that's a lot that goes through from the SOC reporting and the fact that you guys review all of this. It's part of your audits, you're covered as well. If in fact there are successful attempts at fraud, we do have a guarantee at the individual level that if money is accessed and individuals have been diligent in their procedures, we are going to cover the cost of that as we go after return of those assets. Thankfully we've had no issues here with the City of Portsmouth. And then we're part of the Industry Oversight Board, which includes a lot of these members here, just to have consistency on what all providers are doing across our industry. All right, so from a standpoint of data, as Brian said, the portfolio closed 192.6 million at the end of Q2, just over 1,000 individuals that are still either getting a benefit or will be getting a benefit. That's our very high level asset overview. This looks at more of the detail from looking at fire and police, and then we'll look at supplemental. So we look quarter over quarter, left to right. Right is second quarter, and there is one active, as we mentioned, in the fire and police system, and only 40 others that are expecting benefits that haven't started them yet. So again, vast majority of these individuals are receiving monthly benefit checks. This is just, again, very high level showing of flows into the portfolio. The contribution for the year was made in its entirety in Q1, the 6.2 million targeted to this plan here. And you see on average we're issuing, again, about 600 plus checks a month, 1,900 checks on a quarterly basis. There's our one person. Which with greater than 25 years of service, so we're expecting that individual to make a change soon. From an activity standpoint, not a lot of activity. There were 6 individuals who we sent out eligibility notices that they can begin payments if they so choose. We just started only 2 new periodic distributions, one due to a death and a spousal benefit, and the other one was just a new individual taking distributions. And then, as you see, unfortunately, there were 5 deaths. But I like to point out, look at two of those people were receiving benefits for over 40 plus years. So that's a great benefit that the city has provided. Here's same for supplemental system. Again, if we look at the far right, we're at 7 active, so we dropped slightly there. But again, here only 9 term vested. So those are the folks that haven't started taking benefits. All of these 7 actives are over the age of 60. Same information from a cash flow perspective. You see the contribution in Q1 of 1.6. And then here are the years of service. So again, 6 of these folks were over 25 years. And this just speaks to the fact that these systems were frozen so long ago and everyone else goes into the VRS. Limited activity here just based on the small population, just some about 4 new distributions that were started. 1 continued actually from a spousal benefit. And then again, as typically do, quarterly look at overall expenses. If you see left to right, we break out the expenses from from a provider, so investment management, that's the expense of the underlying investments. That's down to under 27 basis points, so extremely low from a expense management perspective. Greystone fees and John Hancock fees, and then total that up, so the systems are running just over 51 basis points, half a percentage point in expense on an ongoing basis. And then this just breaks that out. Typically, we would show a list of all the investment holdings. This is a little different here since at this point all of the portfolio really is held now in the Morgan Stanley Advisory account that has that 27 basis point average expense. And then we just take cash essentially to pay the benefits on an ongoing basis. We work with the back office of Morgan Stanley to try to keep that as tight as possible so we're not holding a lot of excess, and additional amounts are wired over to us if needed. And that's it for me from our perspective. And again, it's always great working with the city, with you all, with the benefits team. So everything seems to be going well, and individuals seem to be happy getting their benefit payments.
And in personal level or finance level, I really would like to thank you for all you do. I really appreciate both you, Tracy, Chris, and everybody.
Yeah,
So
appreciate that. You guys are great partners, so you make
that's
it
on
easy.
you to be recognized for it. So
Yeah.
I really appreciate it.
Thank you.
Thanks, Tom.
You're welcome.
Any further questions? All right, I think we can adjourn.
Thank you.
See you in,